I'm going to demonstrate multi-product CVP analysis through exercise 347. I'm going to go ahead and work through this whole problem because I tend to find this is a tricky area for most students. For this company, they are selling two different types of taco, chicken and fish. Total fixed cost for the company is $117,000. They individually give us the per unit selling price and variable cost separately for chicken and fish. They also give us the expectation of what the sales are going to be in the upcoming period. The first part, part A, says, based upon this information, what do you think profit's going to be? I'm always looking for shortcuts. You can state the whole entire income statement. And in my mind, I think, well, a shortcut to this is calculate total contribution margin dollars, subtract from that fixed costs, and I've got before tax operating profit. So that's what I'm going to do. So first thing I'm going to do is calculate what's the contribution margin per taco individually for chicken and fish. $3 selling price for chicken, $1.50 variable cost for chicken means the contribution margin per chicken taco is $1.50. Now, coincidentally, because they made the variable cost half, the contribution margin is also half. Fish, very similar, coincidentally, the selling price is $4.50. The variable cost is half of that, or $2.25. So the contribution margin is also half, or also $2.25. I multiply the contribution margin per taco times the number of units I expect to sell, and I get total contribution margin dollars. For example, for chicken, $1.50 times 200,000 chicken tacos is 300,000 in contribution margin. For fish, 225 per fish taco times 300,000 is contribution for fish of 675,000. 675,000 plus 300,000 is expected total contribution margin dollars of 975,000. Then the only thing I have to subtract from that is the fixed costs that I were given of 117,000, and I've got what I expect profit to be based upon the mix that I was given here, and that's expected to be 858,000. That's nice. That's what I expect. But for most companies, they're also saying, hey, times might be tough, like they have been over the last year. What's the minimum that I would have to sell in order to just break even? I want to make sure how easy that hurdle is. And in B, they're saying assume the product mix is 40% chicken and 60% fish. So a higher proportion of fish is sold. Now, your book gives you sort of I would consider a buffet of options for calculating multi-product CVP analysis. I tend to prefer the weighted average contribution margin. If you prefer the product mix option, go for it. I'm going to go ahead and demonstrate weighted average. Both of them are going to get you to the same endpoint. My starting point is the contribution margin dollars per taco that we originally calculated above. It's $1.50 for chicken and $2.25 for fish. Then I'm going to weight that by multiplying it times the sales mix, and that is 40% for chicken, and that is 60% for fish. That's the mix they were given. So 40% times $1.50 means that weighted contribution margin is 60 cents. 60% times 225 means that weighted contribution margin is $1.35. $1.35 plus 60 cents is a weighted contribution margin of $1.95. Very similar to the typical break-even calculation. If I want break-even in units, I divide the fixed cost by the contribution margin dollars. Here they're weighted. So that'd be 117,000 divided by $1.95 means I have to sell 60,000 units. Now that's nice, but I also want the detail. That's how many tacos overall, chicken versus fish. So all I have to do is multiply this times my product mix percentages. 60,000 units times 40% for chicken means I would need to sell 24,000 chicken tacos. 60% times 60,000 would mean I would need to sell 36,000 fish tacos in order to just break even collectively. The second part is, what if the mix changes? And here we're shifting more to chicken. So here we were more fish, and I'll give you a hint that's beneficial because each fish taco added $2.25 versus a chicken taco only adds a little bit less at $1.50. We're shifting more to chicken. So a 4-to-1, 4 chicken tacos for every fish taco. Let's rework this. So I start with the same contribution margin per taco. That doesn't change, but my mix changes. If you're having trouble figuring out the mix, I'll go through this quickly. If I'm selling 5 tacos collectively, 4 for every 1 fish taco, 4 divided by 5 is 80% for chicken. 1 out of that 5 is 20% for fish. Again, multiply these percentages times the original contribution margin to weight the contribution margin. 80% times $1.50 is $1.20. 20% times 225 is 45 cents. Add those two together and I get $1.65. Again, exact same process I used before. Fixed cost of $117,000 divided by the new weighted contribution margin of $1.65. You notice it's less, and I would expect that because chicken adds less to it. Now I have to sell 70,910 chicken tacos. Again, expectation is chicken's less, and if that's a higher product mix, I'm going to have to sell more tacos overall. So take that 70,910 times 80%. That means I'd have to sell 56,728 chicken tacos. 70,910 times 20%, and I would have to sell 14,182 fish tacos. So hopefully that helped you out with any problem areas that you had for this problem.